introduce your speakers.
Hey, thanks, Florence. Ladies and gentlemen, everyone, welcome to another episode in the IBF WMI Compliance Masterclass series. Today, we're featuring Combating Financial Crimes, the series, and the particular subject here is asset tracing and recovery in crypto assets. We're all aware that only a fraction of the proceeds of financial crimes are recovered annually. Estimates put this at 3 to 5%. So this makes financial crime one of the most profitable business enterprises. No wonder it's so pervasive and difficult to contain. So the object of asset tracing and recovery, ensuring crime does not pay, remains paramount in this whole sequence of preventing, then because stuff happens, detecting, and then recovering the proceeds of financial crime. The advent of this asset class we're going to focus on today, digital or crypto assets with characteristics including anonymity, transferability, control yourself via crypto wallets, ease and spread, cross-border inter-entity transfers. They present both age-old and novel challenges. But we still have the objective: how do we ensure crime doesn't pay and we actually recover these proceeds? So we are privileged we have a distinguished panel today to take us through this whole cycle. And I see there's already a question in the chat group. How do we deal with conflicting regulations? If you have questions throughout, please do post them in the chat group. Either our next speaker will answer the question, and this particular question will be answered by one of our panelists, or we'll answer them all during the Q&A session at the end. So we will lead off with Antonio Alvarez, Chief Compliance Officer of Crypto.com. Antonio will take us briefly through fiat crypto conversion, how this asset is then transacted, and he'll touch on the regulatory regime for traditional and crypto. I'm not sure Antonio can actually do a conflicts of regulations class here. We have dedicated classes on that, and Shumin in the legal section will actually touch on this. So wait for that. Hammer and Jack. Hammer is Asia Pacific Compliance Head for Zodia, and Jack is a partner with Safe Heron, will take us through custody of digital assets, the differences between fiat and digital wallets, how you can't use traditional tools to trace. And then Angela Ang from TRM Labs will actually conduct some forensic analysis with us. She'll take us through the various techniques and methods. New technologies can be used for crypto asset tracing, and she'll share some real life collaboration that TRM Labs has done with law enforcement. Then Jimmy Johnson. Jimmy has worked with the FBI for more than 20 years, Jimmy, before joining the FTI consulting practice in blockchain and digital. And Jimmy will share with us from a law enforcement perspective, including his experiences with Interpol, FBI, and law enforcement in our part of the world, how you can actually follow the money and recover the assets. And then we'll end up with how Shumin can use the law to actually help us with this. So post your questions, hold your questions, and without more, Antonio, over to you.
Thank you, Sharon, and welcome everybody. My name is Antonio Alvarez. I am the Chief Compliance Officer at Crypto.com. Crypto.com is a global provider of crypto assets, and our mission is to put crypto in every wallet in order to accelerate adoption of crypto. As part of that, we do a lot of crypto to fiat and fiat to crypto. So what I'd like to share with you today is a really brief introduction to digital assets. I just wanted to spend a couple of minutes just to set the foundation, and then go really into some of the traditional digital asset and to fiat flows and some case studies. So with that, just to start setting the stage, as digital assets were imagined as a way of money that can be moved internationally, cross-border, very quickly, very transparently, seemingly without having to have a central provider. Right. So that is the concept of it. But it came really quickly obvious to the marketplace that in order for funds and for value to come in and out of the crypto asset infrastructure, it needed some type of fiat rails, some types of ways to buy digital assets using payment cards, using fiat wallets, using the type of traditional money, including cash, and as well as a way to liquidate digital assets directly into a bank account or a fiat wallet. Because at the end of the day, especially at the beginning of the first decade or so of crypto, it was very hard to buy bread or milk with crypto assets. You needed the fiat. So having those rails was critical. So the evolution of the fiat rails has gone through three different phases. It started with a peer-to-peer exchanges. It then moved to kind of a payment processor enabled flows. And right now, the most popular one is the centralized digital asset service provider. So let me dive into each one of them very quickly, as we don't have much time, to talk about how they work and some of the case studies around it. So on the peer-to-peer exchanges, on the next page, we have the sharing of information. So people come together in a marketplace. The marketplace is just a medium of communication where two individuals are connecting and finding a mutual need, one to sell and one to buy, or etc. Then it's very popular in the beginning, as I said, when there were no fiat rails more established, right? Usually the marketplace in the middle is just a posting board. They position themselves as a Facebook type crypto platform where it was unregulated because they didn't touch the money or didn't touch the crypto. All the crypto transactions happen outside of the platform, and all the funds moved outside of the transform. The actual movement, it would often involve cash. So the two people would meet in person and the blockchain transaction take place, and then cash would exchange hands on a face-to-face environment, or they would do it through a bank. But the digital wallets used at the time were mostly DeFi wallets, because this was happening in a way to actually conduct these type of transactions outside of the financial system and under the oversight of the central banks and the regulators. Our regulators have been very focused on this flow. It still happens, especially in bad money, where criminals use for mules and use for people to help them convert money, fiat to digital and digital to fiat, in this way still through, they use now both P2P exchanges that are dedicated to crypto, as well as other mediums of communication like WhatsApp, Facebook, etc. And the regulators have been very focused on this flow because of the high level of theft, scams, and money laundering in general. Last year, the co-founder of Paxful, one of the largest P2P exchanges, pleaded guilty in the United States to failing to maintain an AML program in the US. Even though as a business they operated out of Panama and the Philippines, the level of money laundering that was happening in the market was high enough for the US regulators to reach in and prosecute. Right? As the maturity of crypto continued to evolve, digital asset, there were new players that wanted to specialize in the exchange of these digital assets and fiat wallets, but they didn't have without having to be necessarily licensed in the jurisdiction it operated, right? So they tend to look for jurisdictions where no licenses were required, or they were operating in jurisdiction where there was no licensing regime or regulatory regime at all. And what they did, so really banks and other institutions would not interact with them or partner with them. So the construct here is where one of these DASPs engages with a payment gateway. So it becomes almost like a merchant of one of these payment processors. The payment processors then enables the DAS just like they would enable an e-commerce type of merchant. They would themselves operate either an payment institution license or an exception if the jurisdiction they were in allowed for a agent of the payee type exception. But in this construct, the payment processor doesn't touch the crypto. They're purely a fiat provider where they either deliver fiat from the DASP to the user when the user is selling crypto, or from the user to the DASP when the crypto is being purchased. While the crypto just moves between the DASP and the user directly, most of the time, again, through DeFi wallets. A typical case study, an extreme case study that was happening in the first 10 years of this, right? And some say this still happens. It's hard to find because they're not published out there, but these Russian-based dApps that will publish a deposit address where criminals can send their crypto into that address, and then a few days or weeks later receive a box through the mail with cash, and they can select what type of cash, if they want dollars or pounds or euros. And the Russian DASP will be just specializing in clearing that exchange. Russian DASP Plus being heavily sanctioned and prosecuted, and around the world, exchanges like Arantex or GreenX are now officially sanctioned by international bodies for doing things like this, as well as mixers and other type of enabling other type of money laundering and tourist financing flows. So it's still out there. Caveat emptor, so buyer beware. This is very important. It's a message that I want to continue to deliver through the presentation, is that you have to be aware of who you're dealing with, and who is the counterparty of the ultimate counterparty of a transaction, right? Either the fiat or the crypto. So it's very important to try to avoid this type of rails and interacting with this type of exchanges or DASPs, right? And finally, the final flow is that I wanted to touch on basis today is the centralized digital assets provider. It's the more common one today. Is where we see most of the flows as the industry is maturing and more traditional players are coming in, more fully regulated and well-intended players are coming into the space. Centralized dApps are becoming the industry standard for exchange fiat to digital assets. They tend to be fully licensed, and they provide both a crypto and a fiat wallet, so that the transactions happen between the crypto and the fiat wallet within the centralized DASP and under the proper licenses. Most DASP will have both a crypto license as well as a fiat license. And then the DASP can maintain under those licenses a full compliance program that meets the regulatory expectations of the central bank, as well as the regulatory expectations of the banking partners that are there to provide the actual fiat rails. And those banking partners could be payment processor, payment gateways, or directly to banks, right? But again, when some of these DASP they're non-regulated out there still, that will be able to do the fiat and the crypto. They just will not have the compliance program to be able to tie in to some banks. So you still see some flows among central digital assets providers, and looking for the one that has the actual rails into the traditional fiat system, right? Payment gateways or banks. But focusing on the ones that actually provide the fiat rails, it's important to understand as a buyer or as a network participant that interacting with them. It's important to understand what is the regulatory requirement and the regulatory investment. What is their licensing structure because most of them will have two regulatory obligations, one under the crypto and one under the fiat, as they will be holding both. So in the last page of the presentation, just wanted to kind of give a comparison. If we can move to the next page on the differences, right, between a DPT or a DASP. In Singapore, we call them digital payment token providers, service providers. They have very similar requirements as the traditional financial services. So they have capital requirements, they have customer protection. Cybersecurity tend to be very similar across both. I separated in the slide for everybody's benefit because of the nuances of the cybersecurity when it comes to the blockchain, the traditional financial services. But when it comes to anti-money laundering and counter-finance terrorism, they're pretty similar across both. Both require KYC, full verification of the users, monitoring, transaction monitoring, suspicious transactions filings, travel rules. So there's a lot of commonalities across the two. So when you're looking for or you're dealing with those type of fiat rails, understand what type of exchange or what type of construct it is, 1, 2, or 3, and be aware of the licenses that your digital service providers hold or do not hold. And I'll leave it there for questions later, and I'll pass it back on to the next panelist.
Thank you, Antonio. So the regulatory regime for centralized DASP is fairly similar to traditional financial services. I think that comes out here. Let me just hand over now to Hema and to Jack, please.
Thank you, Sharon. I'm Hema Chetia, the APAC Chief Compliance Officer for Zodiac Custody. Zodiac Custody is a digital asset custodian for institutions, and we are owned by SC Ventures, Northern Trust, SBI Holdings, and National Australia Bank. So without further ado, I am partnering with Jack Fu in terms of this presentation. So let's go to the agenda page. Next page, please. So I'd like to start off with the TradFi versus digital asset custody first, followed by what is custody in digital assets, and then types of custody models in digital assets and implications on asset tracing, followed by key elements of digital asset custody, including certain regulatory requirements, specifically on the cold versus hot storage requirement in the proportion. And finally, Jack will talk about different custody technology models. Next page, please. So I would like to start off by giving an overview between TradFi versus digital asset custody. What do we custody in digital TradFi? We do stocks, bonds, cash. In digital asset, it'll be cryptocurrencies, NFTs, tokenized assets. Custodians are typically banks, brokers, CSDs, and in digital asset, it'll be crypto custodians like Zodiac Custody, exchanges, or even self-custody solutions, which I'll talk about later. Asset nature in TradFi, physical or dematerialized, and it's centrally recorded. And in digital asset, it is fully digital and decentralized and recorded on blockchains. Ownership records maintained by central registries or intermediaries in the TradFi, whereas in digital assets, it's on blockchain ledger and it's often pseudonymous. Access control is typically via account credentials and legal documentation in the TradFi. In the digital assets, you will see it is controlled by private keys or multi-signature schemes, which Jack will give a little bit of flavor in the coming slides. Security measures in the TradFi, physical vaults, cybersecurity, regulatory oversight, and in digital asset, you will hear the terms cold storage, hardware wallets, MPC, which is multi-party computation, smart contract, multi-signature wallets. Again, my friend Jack will talk about it in detail a bit later. Regulatory oversight is interesting. It's heavily regulated in the TradFi custody. In the digital asset, it's evolving. Countries like Singapore is ahead of the game. It came up with its regulation in 2020, and in Hong Kong in June 2023, if I'm not mistaken, and other countries are still coming up with their consultation papers and regulations as well. Asset tracing in TradFi is typically through centralized records, and In digital assets, it's via on-chain analytics or blockchain forensics, and Angela from TRM Labs will give you a little in-depth overview of the TRM Labs and its products. Asset recovery for both legal recourse, insurance, and court orders are common across TradFi as well as digital assets. I think the one thing that we need to point out is in TradFi, it is certain that you will recover the fiat, whereas in digital asset, it's uncertain as to whether cryptocurrency is recoverable as cash equivalent. And also it's pretty complex, may involve legal action, smart contract reversals, or forensic tracing. And this part, Shumin from Duane Napier will speak about in depth later on. This is an overview between custody in TradFi versus digital asset. Can we go to the next slide, please? So in here, we would like to make a clear definition of what digital asset custody means. It is basically secure management, storage, safeguarding of digital assets against what? Loss, theft, unauthorized access. By what means? Through private keys. What are private keys? It's basically a secret alphanumeric code which enables the owner to access and control the digital assets. And it's like a password to your wallet. And the key call out that I would like to bring about here is you've got two main kind of models. One is self-custody wallets, and the other one is centralized wallets. With regard to self-custody wallets, it's owned by the user. So the control is with the user, ownership is with the user. So what about the asset tracing implication? Typically, it is not linked to an individual or identifiable to an individual, or unless additional data points are available through forensic tracing. Also, if assets are spread across multiple wallets or chains, tracing becomes more complex. And examples would be hardware wallets like Ledger, Trezor, or software wallets like MetaMask Trust Wallet. Now let's look at the centralized wallets. These centralized wallets are mainly run by crypto custodians like Zodiac Custody or crypto exchanges. The control, however, is with the centralized entity. But who is the owner? It's the user. And how is asset tracing feasible in this scenario? Custodians as well as crypto exchanges are subject to KYC and AML, which enables linking of wallet address to verified identities. And also the institutional grade custody solutions enable logs of asset movements, and it also enhances traceability. So you will have examples like Zodiac Custody and Crypto.com. Move on to the next slide, please. Now, with regard to private key management, since digital assets are on the blockchain and are controlled by private keys, custody solutions or solution providers typically look at the security as well as the management of the keys. How is that typically done? It's through two tech terms that I will mention here, multi-party computation, as well as hardware security modules, which Jack will speak in detail. With regard to regulatory compliance, these custodians often adhere to SOC 1, SOC 2, ISO 27001 requirements, as well as some country-specific requirements like proportion of hot versus cold wallets. So in the table below, we've given you a distinction between what's hot versus cold. Very simply, hot is internet connected and cold is offline. And with regard to traceability, both are visible. Cold and hot are visible. However, in terms of the transactions between the hot and the cold, in hot wallets, you will have frequent transactions. In cold, typically, it's infrequent. And what does that mean for asset tracing? Without or lack of sufficient data points doesn't necessarily enable asset tracing any easier. So that's the reason why we've given here as high and moderate. High asset tracing visibility as well as frequent transactions, and for cold is moderate. And these are often tied to hot wallets to exchanges because the transactions are quite frequent, and for cold wallets, typically to custodians. And lastly, before I hand it over to Jack, I just want to call out like operational efficiency perspective. Custody providers typically have, offer tools of transaction management, auditing, as well as whitelisting process. So every wallet addresses would need to be whitelisted, for example, in Zodiac Custody before any transactions are allowed in or transferred out. So without further ado, let me pass it over to Jack, who can go through the technicalities behind MPC and HSMs. Over to you, Jack.
Thank you very much, Emma, for giving that overview on the custody and setting the stage. So just a quick introduction. My name is Jack, partner of Safe Heron, and we are institutional grade MPC self-custody technology provider based out of Singapore as our HQ. And we help our institutional clients to enhance security and governance of the digital asset management, while also being regulatory compliant. And lastly, we serve our clients across the board, from exchanges to payments to asset managers. Okay, so let me just dive straight into the different models of custody, and I'll share more from a technology and a security perspective, right? And early on, Hema already gave a hint on what are different types of wallets, so I'll just expand on that, and I'll start with single private key and versus MPC, right? So MPC stands for multi-party computation, right? So single private key, it's a very traditional form of key management, right? And just now, Hema also highlighted the private key is the digital credential, which you need to prove ownership of your digital assets and also to authorize transfers. So a single private key setup, is typically very simple to implement. It's fast, it's also cost effective, very cheap, right? And for organizations who requires very low latency for high frequency transactions or high frequency trading, right? Typically, that we use single private key setup for faster transaction execution. And usually, single private key is usually managed on a single device and managed by the single users. So that brings to an issue, right? From a security perspective, that the problem is that single private key managed on a single device by single user brings about a single point of failure. If any of these components is compromised, then you may lose your assets. And there has been many, many cases of phishing, social engineering tactics, right? Or maybe the download of a malware that have led to losses, especially, if you're using a very simple hot wallet, like for example, like MetaMask. We have cases before of VC that downloaded a malware, and then their MetaMask wallets, was drained, right? So MetaMask right now, I highlight it because it's by far the most popular hot wallet that's used by many of the crypto participants. And then we, of course, also have hardware wallets like Ledger or Trezor, but these are mostly used by retail. So institutions, if they were to use single private key solution, they usually use it in tandem with hardware security module or and hardware based PE or trusted execution environment, which are all hardware isolated enclave for added security, but that doesn't address a single point of failure. So that brings me to my next part, which is on MPC, right? So how do we address a single point of failure, right? MPC, it's an advanced cryptography that splits up the keys into shards, and it's typically distributed to different parties, held on different devices, and also at different geographical locations. And this cryptography allows multiple parties to come together to compute an output, which is usually to sign, right, without revealing their individual inputs, which is the data of the key shards, right? So, from an attack point of view, if I'm a hacker, now instead of just compromising a single person or a single device, I need to go to every single party, right? Compromise the device and compromise each of the key shards before I can get hold of the the private key, which can lead to the asset. So the cost of attack, it's a lot higher, and that MPC exists in different type of setup, what we call threshold signing scheme. For example, 2 out of 2 or 2 out of 3 or 3 out of 3, meaning, just for an example, in a 3 out of 3 model, we split the private key into 3 parts, and we need all 3 to sign, right? You can't just use one of the key shards or 2 of the key shards. You need all 3 to sign in order to fulfill the signing threshold. All right, so that's one of the ways which security, or custody would use, to better secure the assets. And usually, MPCs is used in tandem with trusted hardware isolated enclaves to make sure that it's a multi-layered hardened security. And today, there are many institutions that uses MPC, together key for the secure protection of the private key, whether it's in hot or cold wallets. Which brings me to my next point: hardware, hot wallets versus cold wallets. Very quickly, hot wallets and the private keys are online. It enables very quick signing or automated signing, usually via API, right? So the pros, you can allow for immediate execution, is for higher efficiency. So it's really very good for institutions that does high frequency transactions like exchanges or payments, or market makers who need this kind of automated programmatic transactions, right? But the cons is that you do have an attack surface whereby, if the keys are not secured properly, then you may lose it, right? And then on the other end of the spectrum, for cold wallets, the private key are kept offline. Usually, it's meant for long-term storage of funds, and that it doesn't involve high frequency of transaction. Usually, it's transactions that are done that's done very infrequently. So these are good, if you're using it for treasury management, but it's not suitable for day-to-day transactions and operations. But cold is definitely needed because especially for regulated entities, as Hema has pointed out, you need to keep a certain percentage of your assets under the cold wallet. So for example, in Singapore, it's 90%, in Japan, it's 95%, in Hong Kong, it's 90%. Right. Just one thing that I'd like to point out is that the misconception is hot wallets are usually unsafe and cold wallets is safe. But if we look at history, especially the Bybit hack, which occurred earlier this year, which is a record-breaking hack, it's about 1.5 billion that was being lost. It was a cold wallet that was being used, right? But it was breached. And I also like to highlight that hot wallet doesn't mean unsafe, because there are many MPC paired with TEE that are actually very secure and is used for all their day-to-day security operations. So it really depends on the security infrastructure that is used, whether you have a very robust zero trust setup. It's also about enforcement of policies as well as users awareness, right? So, and then that brings me to my last point. Oh, sorry, I just wanted to add also, it's also very common for entities to use hot warm wallets for their day-to-day operations and cold wallets for storage, right? So the last part will be to talk about the different deployment models, right? Typically, there are three, right? First, it's the SaaS-based or software as a service model. This is the most common, right? It's typically vendor-hosted. So infrastructure is hosted on the vendor side, and it allows for fastest time to market, very low cost of implementation, high level of security, low operational expense. But the trade-off is the lack of control over the infrastructure, and then you don't have the control over the data residency, as well as data privacy of your wallets, because your vendor can see, basically all your wallet data. And on the other end of the spectrum, typical for mid to larger size institutions, especially banks or exchanges who require maximum control and data sovereignty as well as privacy of the data, then they might want to have it hosted on their own premise, right? So it's like private deployment. This allows them greater control over their infra, greater flexibility in how they want to customize their workflow. But the trade-off is, of course, everything always has its trade-off, is that usually comes with greater complexity of implementation, greater cost, and there's more things that they need to manage, like they need to run their own nodes, they need to run their own server setup. And if it's not done properly, then you may also lead to a security issue. And then, of course, we also have an in-between, which what we call a hybrid setup, whereby an organization may have maybe the most core infrastructure, which typically like the key shards to be held on their own premise, and the non-core infra to be held on the vendor. So that's also possible, and that's how some organization can lead. They can lead to an outcome that they want, that is a balance between security, control, and cost, and then they can have somewhat the best of both. So if I could just summarize, there is no right or wrong approach in all the different methods, because there's no one size fits all, and all of it depends on your requirements in relation to security, operations, compliance, and cost. All right, so that's the end of my portion, and I'll pass it over to Sharon.
Thank you, Jack. So in this segment, we covered self-custody and centralized custody in Hema's segment. And then Jack also elaborated a bit more on hot and cold wallets. In the next section, which we're coming to, Angela will take us through how you can actually trace who is the wallet owner, where do the assets sit, and at what point in time you could actually trace and attempt some asset recovery. Over to you, Angela.
Thank you very much, Sharon. Hi, everyone. My name is Angela Ang. I represent TRM Labs, and we are a global blockchain intelligence company. We work with financial institutions, crypto businesses, regulators, and law enforcement to detect and fight fraud and financial crime in cryptocurrency. So prior to joining TRM, I actually spent over a decade with the Monetary Authority of Singapore, and most recently, I was in charge of licensing payment and crypto service providers in Singapore under the Payment Services Act. So today, I will be providing a brief introduction of the investigative part of the asset recovery workflow, or what we like to call following the money. Next slide, please. So first, I want to start off by explaining how do blockchains make it possible to follow the money. Now, most digital assets, right, they actually move on what we call public blockchains, where every transaction is permanently recorded on a public ledger, and this ledger is accessible to anyone with an internet connection. So what this means is that, if you have a blockchain wallet address, you can actually look it up right now using a block explorer, which is, you can think of it as like a web browser for the blockchain. So but what you'll see is something like what you see on screen right now, which is actually a block explorer screenshot, and that's a pseudonymous record. So basically what we will end up seeing is a wallet address, which is a string of letters and numbers. You can see the transaction history, but who does this wallet belong to? What are the transactions for? Just by looking at raw blockchain data, you have no way of really knowing. And so this is where blockchain intelligence firms like TRM come in. So as a simple analogy, right, I like to describe what we do at TRM as being like Google Maps for the blockchain. Next slide. So looking at raw blockchain data is kind of a bit like looking at a satellite image like the one you see on screen. So there's a lot of rich data, but it's very hard to interpret it without context. Next slide. But when you look at the same image on Google Maps, you can actually see that this image is a view of the area around WMI. And here the information becomes useful. On Google Maps, you can plot directions, you can even get traffic information, for example. Next slide. So this is basically what companies like TRM do for the blockchain. So like Google Maps, right, instead of just showing you the raw data, we add layers of context. So what we do is we identify things like whether a wallet address, does it belong to a legitimate exchange like crypto.com, or does it belong to a sanctioned group, a criminal network? So then with this kind of information, investigators, they can actually start to follow the money. They can connect the activity in these wallet addresses to real world entities and individuals and understand the bigger picture. Next slide. So this is a simplified investigative graph of a scam case. And as an example, in a scam case, you might actually see funds that are moving from a victim's wallet address, those in green, to a series of suspect-controlled wallets, self-custody wallets in red. And then finally in blue, we see an attempt to cash at an exchange by basically, changing the crypto into fiat. And so this point at which funds hit an exchange or any other sort of virtual asset service provider or VASP or DASP, as Antonio called, I think sometimes they're called CASP as well, but basically the same thing. So this point at which funds hit a VASP, right, is a critical juncture for many blockchain investigators. Next slide. So let me just briefly explain why. And that's really because if the VASP is a regulated compliant VASP, then they will actually collect KYC information, and oftentimes they're cooperative with law enforcement. So investigators, they can reach out to the exchange to actually get KYC information on that, and therefore connect the pseudonymous wallet activity to a real identity. The other point here is that once the funds enter a VASP, investigators actually cannot raise beyond the VASP without the cooperation of the VASP itself, because in a VASP, customer deposits, withdrawals, they are kind of managed by the platform. So you do need the platform's support there. Next slide. So unfortunately, it's not like criminals are just directly cashing out at VASP and then making themselves easy to find. 10 years ago, this kind of was indeed the case because crypto at that time was unregulated. It was not well understood. So the very fact that you're transacting in crypto alone is enough to be off-grid. And criminals at that time, they could just move funds straight away from an illicit marketplace into an exchange, then they cash out and they're done. But today, both regulatory as well as investigative capabilities have advanced dramatically. And so criminals themselves, they also have become far more sophisticated, operating in what you see in the graph on the right. This is an investigator's graph that is following the money in a North Korean crypto hack. And so criminals today, they are creating a web of movements using obfuscation techniques to throw investigators off. And North Korean hacking groups are actually one of the most skilled at doing sophisticated laundering on the blockchain. Next slide. So some common kind of obfuscation techniques, which you may actually have heard of, include things like mixers, cross-chain swaps and bridges, and privacy coins. So does it mean that once you hit one of these, it's a dead end? Not necessarily. It is possible to follow the money in some cases, even when such techniques are used, but it does require the right tools as well as advanced expertise. So, we do at TRM have very highly skilled investigators that specialize in what we call demixing. We also offer automated cross-chain tracing, but even with these tools, even with the right expertise, it's not 100% successful. So, because these tools are designed to obfuscate the flow of funds. But what's equally important to note, especially if you work in compliance, is that if you see one of these typologies in the flow of funds, it could be a sign of potential risk. So for example, if a crypto exchange, they see funds coming in from an address that's associated with a mixer, even if they don't know where it came from before it entered the mixer, the fact that it came from a mixer is already something that they want to look into further. When it comes to privacy coins, actually many regulated exchanges do not really accept privacy coins or do so only with very, very significant controls. So the liquidity of privacy coins is much less actually than mainstream cryptocurrencies like Bitcoin or stable coins. So while we often hear talk about criminals using privacy coins, the reality based on what we're seeing on chain today is that a lot of the illicit activity is still in much more widely accepted assets like Bitcoins and widely traded stablecoins. Next slide. So finally, I do understand that we have many folks joining us here today from non-crypto native firms. Maybe you work for a traditional financial institution and you may be thinking, so if we don't handle crypto or we basically don't onboard crypto clients, then this, why is this a problem for me? And here the point I want to make is that the reality is that criminals, they don't confine themselves to just one ecosystem. They exploit both crypto and traditional finance, and they often do so together. So one example is shown in the graph on the slide, which actually illustrates the flow of funds in Australia's largest money laundering conviction, where we actually supported the Victoria Police in the investigation. So as you can see, everything on the left in light blue will be typologies that are quite familiar actually to TradFi compliance teams. ATM deposits, bank accounts, shell companies, and none of this is actually occurring on chain. But what happened after that is that the funds were then moved into crypto and then they were further laundered. So we are seeing criminals kind of straddle both the fiat world and crypto world to kind of obfuscate the flow of funds in a more sophisticated manner. And we are also seeing mainstream adoption of digital assets grow quite rapidly. And so as digital assets, they start to become more integrated with traditional finance, financial institutions will inevitably become increasingly exposed to this kind of crypto-related risk, even if they don't directly offer crypto services. Next slide. So the question on your mind might be, okay, so how do I manage the risk? If I start we don't really have time to cover this in detail today, but I do want to point to a few useful materials. So the first one is that in Singapore, the ASIP, AML CFT Industry Partnership, they have actually offered some guidance on managing MLTF sanctions risk for virtual asset customers. So here they actually cover, among other topics, the use of specialized tools such as blockchain analytics or what we call blockchain intelligence. I do recommend that you give it a read. And the other resource that I would like to share today, next slide, please, is a 5-part guide that's actually written by our compliance advisory team that's actually composed of folks that have worked in FCC functions at financial institutions as well as crypto businesses. And it covers how to identify and manage various sources of crypto-related risks. So we cover things from like understanding the exposure of your wire transfers to conducting due diligence on vast customers and even crypto source of wealth checks. So if you find that some of these problem statements are resonating with you, you can get a copy by scanning the QR code on screen. And of course, I'm also happy to connect with you and chat further. So don't hesitate to reach out. I think my contact details are on the next slide. So feel free to drop me an email or just connect with me on LinkedIn. So with that, just a very quick overview of what it means to follow the money, and I'll hand the time back to Sharon now. Thank you.
Thanks very much, Angela. I think this presentation also links to one of the questions. It's a very good question in the chat group. Despite skepticism about cryptocurrencies, the future of money, why do the asset prices continue to rise? Well, apart from, I think Angela has pointed out, money laundering takes place across traditional and virtual, digital, crypto, whatever you want to call it, assets. It's the whole financial ecosystem. And digital or crypto is just one kind of asset class where you can extract value. With Bitcoin potentially being a reserve currency for the US Treasury, and with a number of funds, endowments even, looking at this digital asset class as being eligible for investment. This type of issue, what we're talking about today and what Angela pointed out, is going to continue to be increasingly relevant. I think without more, I'll hand over to Jimmy first. Then Jimmy, if you also want to talk about the question on Lazarus Group, we can do that in your segment or later. Okay, over to you, Jimmy.
Okay, thanks, Sharon. Hi, everyone. I'm Jimmy Johnson. I'm a director with FTI Consulting's Blockchain and Digital Assets practice. In my previous life, I was an FBI supervisory special agent for 20 years. And I worked a variety of criminal matters, specifically organized crime, complex financial crimes, and then the latter half of my career was predominantly cybercrime, and along with that involved cryptocurrency and those types of crimes. Next slide, please. So one of the first things I wanted to touch on was just what is the mission of law enforcement, or what's our goal? And you'll kind of see on the left-hand part of the slide there, kind of 3 revolving priorities that we have, and those fluctuate based on the case and the matter at hand. Ultimately, as a law enforcement officer, as a cop, my goal was always to put handcuffs on criminals. That's ultimately what we would like to do, but that's not always the case, and it may not be feasible or attainable. So in other matters, the priority may be recovering assets, and I'm going to touch on some of these case studies and as I move along. And then third would be disrupting criminal networks. If we can't arrest them, possibly we can disrupt the criminal enterprise, and that could be seizing their assets, whether it be fiat bank accounts or crypto accounts. It could be imposing sanctions, new regulations, whatever the matter is, to make business hard for them to do. And that's, and sometimes we consider that a win if we can do that. As far as crypto cases go and cybercrime, more broadly, it can't be done by a single agency. I don't know if I've ever been part of a cybercrime, crypto crime type of investigation that was singular and just the FBI. It was never the case. It always requires partnerships, and we've emphasized that a lot, between all the federal agencies of the U.S. Department of Justice to working with Interpol. I mean, I know, you all have IGCI right there in Singapore. To Europol, I was stationed at Europol for a while, working with EC3, their European Cybercrime Center. And you have, all these national agencies sitting side by side, sharing intelligence and working together on these complex global investigations. And also we rely on blockchains analytics firms such as Angela at TRM or Chainalysis or Elliptic, the regulators, the financial institutions, fiat financial institutions. And then the NCFTA is just an example of another partnership. And if you're not familiar with them, they're based in Pittsburgh, Pennsylvania. It's the National Cyber Forensics Training Alliance, and it's a partnership between law enforcement, multiple law enforcement agencies sit there, along with private sector partners and academic partners. And they all work hand in hand to work these investigations, very complex investigations. It's just one example of the partnerships that we try to emphasize and that we as FBI and US law enforcement more generally participate in. Next slide, please. Just so you understand maybe the scale of crypto crime, and Chainalysis, TRM, they do fabulous jobs along with the FBI's Internet Crime Complaint Center, put together annual reports on losses and the impact of these types of crimes. In 2024 is estimated between 45 to 51 billion US dollars was sent in crypto to illicit addresses. And that could be sanctioned addresses, nation state addresses, such as Lazarus Group, which is North Korea. It could be known scam addresses, fraud addresses. So in general, that's how much was lost in crypto because of crypto crime or illicit activities. And then specifically 10 to 11 billion dollars was attributed to crypto scams. And those could be a variety of pig butchering scams, investment scams, romance. But I also wanted to highlight, since emphasis on recovery in this presentation, is recovery scams. And unfortunately, those are on the uptick. And that's where a fake law firm, a fake recovery company will contact a victim of a crime and say, hey, we can help you get your crypto back for a $10,000 fee or whatever it might be. And unfortunately, you will find victims are being double victimized because they've already been scammed once by a pig butchering scam, investment scam. And then the same scammers, the same bad actors will contact them again saying, hey, we're a recovery firm and we'll help you get your assets back. And they're, the victims they're very emotional, they're distressed, they're embarrassed, and they fall for it again. And so we're seeing an uptick in those. The challenges of law enforcement, Angela already touched on a little bit, cross-chain swaps, mixers, privacy coins, non-cooperative jurisdictions. We run into that fairly frequently. So these are all challenges of law enforcement, and that's why global partnerships are of the utmost importance. And some of those partnerships I kind of have highlighted down at the bottom. IC3 is the FBI's primary portal for victims to submit complaints of online fraud, online scams. It's also used for other matters, but primarily that's what it's intended for, the Internet Crime Complaint Center. And they do a fabulous job of intaking all of this victim information, analyzing it, finding links between cases, and then they're able to build a significant case out of that. So when one singular victim submits a report that they lost, say, $1,000 to an online scam, it may seem like nothing at first, but because the IC3 is able to attribute wallet addresses, IP addresses, email addresses, whatever they may find the commonalities, suddenly they've built a case with 400, 500, 1,000 different victims that then they will assign to an FBI office or work in conjunction with an international partner to try to work that broader, bigger investigation to take down that criminal enterprise. Operation Shamrock, I wanted to mention them real quick. If you're not familiar with them, you can find it on LinkedIn or operationshamrock.org. Started by just a local attorney out of Southern California, Erin West. You may have seen her on LinkedIn already. She is passionate about helping victims and trying to recover funds from these pig butchering scams. It has grown into, it's an official entity now. She got it licensed as a nonprofit organization here in the United States. And they have over 2,000 partners, the Crypto Coalition, she refers to it as, between international, global law enforcement, from in the US, all the way from local, state, federal level, and then international partners to private sector partners and academic partners. And their sole purpose is try to help victims of these types of scams potentially recover assets or bring the bad actors to justice. And they've had great success, and it's a great organization. So I encourage you to check that out. And then other tools, like you may have heard, the US President Trump just passed the Genius Act here just a few weeks ago, which gave some enhanced authorities to law enforcement and better regulation around stable coins. If you're not familiar with a stable coin like USDT or USDC, these are tokens that are pegged to the US dollar. So it's roughly, stabilized at a 1-to-1 value ratio. And those are also the two most common coins or tokens utilized by bad actors for their scams. And why? Because they're stable in their value. And the bad actors want that US dollar. So, things like that, legislation give us more powers. Next slide, please. So just a few case studies we'll go through to kind of highlight some of the different, like I said, the missions and the outcomes of these. And all of these are recent cases. They either had judicial actions or enforcement actions in 2025. And some of these are still working their way through the prosecution system. So they may not be finalized yet. But this first one was a Ponzi scheme. And this was basically your old-fashioned Ponzi scheme like you would do with fiat currency. It's just that this guy, Duver Braga, a Brazilian, moved to the United States, and he did it with crypto. And primarily he was active between 2016 and 2018. And he got tens of thousands of investors to invest in this fake, crypto investment platform, Trade Coin Club. And it was a fake, basically website, fake platform where the investors would deposit their money, and then he would generate fake returns for them. So when they logged into this website, it looks like they're making astronomical returns, and they're very happy, and they let their money sit there. And then it's a Ponzi scheme in the sense that he was paying some dividends back, to the early investors with the more recent investors' money. Ultimately, he ends up getting caught, but you see the scale of this. He had victims across 231 countries. Over 82,000 Bitcoin was deposited into this. It was a joint case between FBI, CRS, or IRS, private sector partners, international partners. He ended up being arrested in Switzerland and extradited back to the United States. And just at the end of April of this year, Brazilian authorities executed numerous search warrants down in Brazil for other participants in this scheme, and also for assets. And they seized, let me see, I wrote it down here, $280 million in assets were seized. And that was everything from properties to vehicles to luxury items, and also bank accounts and crypto. So hopefully some of that money is going to end up being funneled back to the United States and returned to victims. The second example of this Ohio pig butchering scam, this is a great IC3 example. It started with one elderly lady, senior citizen, victim of a pig butchering scam. She got involved by just getting a random mistaken text message, and then they lured her into this pig butchering scam. She lost over $600,000, her entire life savings. Like I said, she was a senior citizen. She reported it through IC3. Well, they started looking at it, doing their intelligence analysis. They linked it to other victims. And ultimately, the FBI was able to trace this money to two Tether wallets that contain this USDT, like I was just talking about, because that's the bad guys love that. And there was $8.2 million sitting there. And so the FBI was able to work with Tether to actually seize that money and return it back to law enforcement, and then make restitution to the victims. So there were no bad guys arrested, no bad guys have been identified, but they did find the money and was able to recover it. And the great thing about these stable coins, and working with partners like Tether or with Circle that controls USDC, Think of it, a very simplistic example is using fiat currency. Imagine someone has a $100 bill in their pocket, a stolen $100 bill. Well, that $100 bill has a unique serial number on it. Now, if the US Department of Treasury could just magically invalidate that $100 bill, basically take it out of circulation, and then reissue it back to law enforcement or to the rightful owner, that's kind of what happened here in a crypto sense. And so it's great working with partners like Tether and Circle. Next slide, please. Now, this is a great one of a large-scale criminal enterprise organized crime. Malone Lam, you see pictured there, 20 years old. He's a Singaporean national, came to the United States in 2023 on a 90-day tourist visa, ends up overstaying his visa. And then he basically built a criminal enterprise through online gaming. He was an online gamer. He met many others. They were all interested in crypto, all interested in crime and getting rich. And he built himself a criminal enterprise that conducted a variety of crimes. He had, and this is organized crime. It may not be, the Yakuza or the Italian mob, but it is organized crime because everyone had a job function and they reported up to Lam. He had hackers, computer hackers. He had callers. These would be the social engineering aspect of it. Callers that would call up victims and pose as a, crypto.com customer support representative, to pick on Antonio there, or money mules or and he had home burglars. They were actually, doing home invasions of people looking for hardware wallets. As Jag and Hema described earlier, hardware wallets, nothing more than like an external hard drive that has all your cryptocurrency stored on it. The same as having your home safe that has your cash in it. So, and they were doing, stealing those. And then laundering the money through, various ways and through mixers like Angela mentioned, and then buying all kinds of luxury goods. They were going to nightclubs, spending up to $500,000 a night at nightclubs. Lam was renting homes between Los Angeles and Florida. He had homes with rent of $68,000 a month. You see his fleet of cars there. I like the one car in the lower right-hand corner that's on a turntable, so it actually would spin in his garage. But he was, they had indictments and arrested, I think, 12. There's still 2 at large. And so this is still, he goes to trial in October. So this is not, finished prosecution yet. And the last case study, again, another recent one, largest Secret Service seizure of $225 million. Very similar to the Ohio case where it started with some, just singular victim reporting. IC3 and through other partners and intelligence channels, we were able to build that out to over 400 plus victims. FBI was involved in this, global partners, industry partners, and working with Tether again, was able to recoup and recover that $225 million. Again, no bad guys have been arrested, but they're still working through that aspect, but at least they were able to seize the funds and hopefully make some restitution, if not in full, but partial restitution to the victims. So it just again shows how multi-agency cooperation can work at scale for these types of successes. And that's it. And Sharon, back to you.
Thanks very much, Jimmy. So Jimmy brought up a good point. You may not be able to trace the bad actor, but you get the money back. So which is more important in the overall scheme, although we would desire both. There are also some really good questions here in the chat on, is there an IC3 government equivalent? So I would like to share with everyone, we must especially thank Jimmy. He's actually dialing in from Colorado, which is day is night, night is day. There's a 14-hour time zone difference. And we specifically invited him to show a global lens on this asset. So to the questions then, IC3 government equivalent, it's the STR, suspicious transaction reporting filing process that all financial institutions have. Then with the Singapore Commercial Affairs Department, MAS, and when you saw the pictures of these cars and luxury wallets that Jimmy flashed, did it not remind you of a similar large money laundering case in Singapore? So there are some similarities. Let me just hand this off to Shumin before we address the other questions. And I think there are some questions for Angela, which you can address also perhaps on the Lazarus group, as well as the one that was sent to you. Yeah, over to you, Shumin.
Thanks, Sharon. After all that doom and gloom, I was going to say what was going to make the same point, which is that first, I'm from Drew Napier. We're a Big Four law firm in Singapore. I've handled disputes at Drew Napier for the past 17 years, acting for banks, acting for FIs. And the point I wanted to make is that hacks, scams, fraud, theft, they happen as they do in what we call Web 2, which is the normal traditional finance sector, as they do in Web 3. So, there is this, oftentimes there's this impression of, Web 3 being a bit more different or a bit more exacerbated, but it happens just the same in TradFi as well. Can I have the next slide? So what I'd like to go through is three things. One, what court orders can we obtain to get back the stolen cryptocurrency? Second, how do we recover it in Singapore? And then touching very lightly on how to recover it outside of Singapore. Next slide, please. The first thing when we, sorry, I think you've skipped one. If we go back, yes. The first thing that I want to say is in recovering assets, timing is key. So a lot of the conversation till now has been about tracing the crypto as it moves along the way. And Angela showed us that very complex spider web of how, the monies, basically what happens is they split it into many small parcels into various accounts so that it's easier to withdraw. Obviously, it's easier to withdraw $10,000 than it is to withdraw $10 million. What they also do is they change it into different forms. So just now, when we mention changing the chain, so you basically change Bitcoin to Ethereum or to a stable coin, so it's harder to trace. But speed is important because all of that can happen very quickly. When a hack comes in, what I'm told, and Angela can speak to this, is that usually there are test hacks, there are test transfers before the actual hack happens. And between the test and the actual hack, it's a matter of minutes. So things can happen very quickly. So speed is important. And next slide, please. The sorts of court orders that we get is the sort of court order that we can get is basically to hold things in place. What you want to do is you want to freeze the assets once you know where they are, and you have to freeze them as quickly as possible. Jack spoke just now about how there are hot wallets. So basically, this means wallets that are connected to the internet. Now, as a litigator, I love it when I'm happy when the assets get traced to centralized exchanges like Antonio's. I know everyone's somehow or other calling out Antonio today, but like Crypto.com, centralized exchanges, they need to KYC, they need to AML, like Angela mentioned just now. So what I can do is I can get disclosure orders and I can get it against the centralized exchange because centralized exchange, they control the assets. Once it's in a cold wallet, and you can think of it basically as the asset sitting in a hard drive that's offline, it has to come online once in a while for the transfers to take place. And that's when, although the Bybit hack was a cold wallet, that's when it was connected at that moment. That's when the hack took place. But once it's off the cold wallet, it's very hard for me to reach it because I don't know where the hard drive is. So when it's in a centralized exchange, I like it because I can get injunction orders to freeze. Now, the first point that I want everyone to take away is, one, speed is important. Two, and this is important, I'll go through the court orders, but the second point is, I don't necessarily need to be able to trace that that exact coin, that exact cryptocurrency. So when I sue someone for fraud, basically, it's framed as conversion. Basically, I'm saying, look, you stole my cryptocurrencies. The orders that I seek are, I want an order ordering you to pay me the cryptocurrency. So it's a proprietary order. That means that it's good against the whole world. That property is mine. Everybody has to recognize it, that it's mine. As you know, like a house. If I own the house, everyone has to recognize that I have a house. That's a proprietary order. I get that order for the cryptocurrency, but I also get, in the alternative, I also get an order for damages if I can't get the crypto. So basically, in simple terms, I get an order saying, give me the crypto assets, and if you don't give me the crypto assets, pay me the money equal to the value. And with the monetary judgment, as we'll see later, there is a lot more flexibility in how I can recover. So first, a proprietary injunction. This one, it's a long slide. I'll just sum it up. Basically, there was this fraud over NFT. I don't know how this case worked in the Web3 world, but basically someone said, I'll give you this very special NFT as a collateral, but you're not actually allowed to take it. And it was accepted, and of course the other person took it. And so the lawsuit was commenced, and the court granted a proprietary injunction. So proprietary means, like I mentioned, it means that it's good against the whole world. Everyone has to recognize it. So I can get these sorts of injunctions quickly to freeze the assets because, like I mentioned, first point, speed is key. Next slide, please. That injunction was obtained in another case, CLM and CLN. We will be sharing these slides after the talk, so in the interest of time, I'll move on. Next slide, please. Okay. The other sorts of injunction I can get, so proprietary injunction, it holds the asset, it says, don't move it, this belongs to me. Another one that I can get is a freezing injunction. So this freezing injunction, some of you might be familiar with the term Mareva injunctions. This is a lot more powerful because it's against all of your assets, up to the level of the claim. And I can get freezing injunctions in Singapore. I can also get worldwide injunctions. Of course, it's a lot more difficult to get a worldwide injunction than it is a local injunction. But as a litigator, freezing injunctions are very powerful strategically because it basically chokes your daily living. It makes your daily life very difficult. There will be a carve out that says that you can use X amount per week to go to your daily living expenses. I've been in cases where, we've argued about how much that threshold should be because so-and-so needs to pay for her daughter's tuition classes. And I've had judges screaming at me about why is tuition so expensive. But in reality, once you get this freezing injunction, you serve it, you deliver it to all of the banks in Singapore, to the custodians, to exchanges. The Web3 exchanges frequently get these sorts of injunctions. And once you have these injunctions, the people holding the assets, in practice, they'll put a hold on the account because nobody wants to be in breach of the order. If you assist, if you know someone's not supposed to move the assets and you help them move the assets, that amounts to contempt of court. So freezing injunction, very powerful tool. I can get it if I can show, the key point is the second bullet point, a real risk that the defendant will dissipate his assets to frustrate the enforcement of an anticipated judgment. So basically, if I can show the court that this person there's a risk that once he knows I'm going to sue him, once I commence my action, he's going to squirrel away all of his money in order that even if I win at the end of the day, I'm not going to get anything. Once I can show that, I get the freezing injunction. Now, when we talk about Web3, cryptocurrency, hacks, and frauds, usually it's quite it's not difficult to cross this threshold because of the nature of the asset, and usually because the frauds are rather complex and they require quite a lot of planning. Next slide, please. Now, the third kind of order that I can obtain, and this is most important to me, is the disclosure order. So we can go to the good guys in the industry, people like Antonio, the centralized exchanges, the licensed entities, because they need to KYC and they need to AML. So I've been in quite a few cases now where we go to the court, we say, look, this fraud has happened. I've traced it to this centralized accounts in these 5 centralized exchange and these 5 cold wallets. Can you please give me a freezing injunction against the bad guys? I don't know who they are, but I can move against persons unknowns. Give me a disclosure order, ask the exchanges to give me the account information relating to these accounts, and that order has been made, and it's very effective because that helps us to identify the bad guys, and that identifying is key because that information then gets sent to all of the various police authorities around the world. Now, disclosure, this is where I do want to highlight that there is some divergence between TradFi and Web3. I actually find it slightly easier to obtain the disclosure order when it comes to the Web3 world, because many of you, those in banks and financial institutes, will be familiar with the general confidentiality provisions in the Banking Act. The law on this point is quite it's a bit convoluted, and it's also because of historic legislations. But basically, the only sorts of documents that we can get, first, there must be ongoing court proceedings, and second, it's only bankers' books that can be obtained. And bankers' books takes very archaic meaning. It means ledgers, day books, cash books, account books, and all other books used in the ordinary business of the bank. So like I said, these are words which we don't really use today. So because it's a lot more difficult to, so here is one thing where I think it's actually Web3, it's easier to get the disclosure order. The scope of the disclosure order is generally wider. Usually what I get is all account information, your AML, your KYC, so I get the passports and all those sorts of things. Those much more difficult to obtain than in the TradFi world. Next slide, please. Okay. So here, damages, again, it's a long slide. Here, the sharp point is this. I get an order. How the cases usually unfold is we start the case, we get these orders, freezing injunction, proprietary injunction, disclosure orders. We get it right at the start when we commence the action without notice to the other side. I move without notice because once I give them notice, the assets are gone immediately. So I get the freezing injunction, I serve it on them so that they usually, sometimes they move the assets anyway, but at least then I can get them from contempt of court if I find out who they are. Then what happens under the court process is the defendant needs to come, enter an appearance and say, I'm going to fight this case. 99.999% of the time, they don't enter an appearance because they don't want you to know who they are. Once I know who you are, the police know who you are, the police can go after you. And more importantly, when I get damages, so this point, remember I said I get an order for the crypto. If I don't get the crypto, I get an order saying pay me the money, the value equivalent to the crypto. Once I get a damages order, I can move against you anywhere in the world where I know you have assets. So I don't have to take my recovery only in that Bitcoin, that Ethereum. I can take your house, I can take your wine, I can take your paintings, anything that is of value, really. Next slide, please. Yes, next slide. So when touching briefly, in the interest of time, on how to recover assets, in Singapore. I think many of you will be familiar that in Singapore, well, basically, once I get the monetary judgment, the judgment ordering you to pay me however $1 million, I can garnish. That means if someone owes you money, I can get an order asking that person to pay me instead of paying you. Now, whether I can get this against the exchanges, that's not so clear in Singapore yet because it has to be viewed similar to money. Now, that order appears to have been made in the UK. To my knowledge, it's not been made in Singapore yet, but I imagine it may be done soon. Examination of judgment debtor, I can get an order. Basically, I get to cross-examine the defendant to ask him where his assets are. And then, usually they try to conceal. If they conceal, then we move against them for contempt. The problem here is, like I mentioned just now, they don't appear. So I don't know who they are, so I can't examine them. So this is of less utility, but still an option of the table. And the last is bankruptcy. If we know who they are, we can put them into bankruptcy. The Singapore court has, in quite a novel judgment, said that the debts or the cryptocurrency debts owing, the liabilities owing, those can be taken into account in order to determine whether you can meet your liabilities on an ongoing basis. Next slide, please. Now, I'll take just a minute. Once I get the Singapore court order, I can enforce it overseas. But here is the biggest limitation. It's a quirk of the legal system that under common law, you can only enforce money judgments. So whether or not that applies to an order for you to transfer cryptocurrency, that's not in a reported decision yet. My guess is, like Antonio mentioned just now, there are these, many of you will be familiar, there are these things called stable coins. They're the rage right now. Basically, they're pegged to the US, they're pegged to something. Frequently, they're pegged to the USD. And there are two main ones, USDT and USDC. Like Jimmy mentioned, USDT is great because what Tether can do, the issuer can do is essentially he can cancel the fraudulent USDT and reissue it to the victim. Now, of course, that comes at a price, but at least you get some recovery. So what is unclear right now is whether when I get my damages, when I get my money judgment, when I get a judgment ordering you to pay me certain stable coins or cryptocurrency, can I enforce that overseas? And the difficulty, again, like I mentioned, is that for a foreign judgment to be recognized at common law, the judgment has to be for a definite sum of money. So that is very archaic, but that's the last point that I wanted to make, and I should wrap up in the interest of time. Sharon, back to you.
Thanks very much, Shumin. So I think someone commented, be nice to Shumin because she can clean you out. There's a whole series of questions. If anyone has questions at this point, you can post them. There's questions fall into two categories. One about can have in the Bybit hack, was there actually recovery? And then specific cases like the ZipMac exchanges. So, and then there's another series of questions around. So I'll ask Angela to answer, can it be recovered? There's another series of questions around cross-border regulations, how they look at cryptocurrency. I think the first thing, which it's now assumed, this is actually now recognized as an asset or property, so you can actually seize it. But as Shumin said, is it really money yet? So there are still questions that need to be addressed. And then Shumin said she can clean you out for the value of the asset. Well,
Shumin did
you
not say
remember.
that.
Okay, the card said that Shumin put it so eloquently. She is cited. the $2 million pizza, which was bought by a couple of Bitcoin. How do you value these, right? So I'm going to ask Antonio to address a little bit about, first Angela, on recovery, and then Antonio on cross-border regulations when they conflict, what happens, and then maybe Shumin, if you want to wrap up on the question on ZipMax, and then just hand it over back to us, and we will do a wrap up for everybody, including the ones who would like the slides and the ones who would like to learn more and join our community. Angela?
Thanks, Sharon. So to answer the question specifically on the Bybit hack, yes, there have been significant funds that are frozen. Bybit actually tracks this on a website called lazarusbounty.com. There are two significant freezers that I wanted to, or groups of freezers that I want to mention. One is about 42 million that was passed through a protocol known as Mentor. And those funds were basically saved because of smart contract code that actually has an automatic withdrawal delay. So they were actually able to recover the funds before they went into the possession of hackers. The second one is funds that were frozen through efforts of stablecoin issuers. For example, Tether, I think $11 million in funds have been frozen through Tether, and a good bit of this was through the work of the T3 Financial Crime Unit. T3 stands for Tron, Tether, and TRM. Basically, TRM provides the investigative capabilities, working with Tron and Tether to identify and then freeze assets connected with illicit activity on the chain. So if you want to take a look, they're still tracking it in great detail on lazarusbounty.com. And if you want to watch something a little bit more digestible, there's a documentary on Netflix called Biggest Heist Ever that talks about the investigation into the Bitfinex crypto hack that happened in 2016 and how the hackers were ultimately brought to justice and the funds recovered. I think it was over 100,000 Bitcoin, which is worth billions today. So some examples here.
Yeah, thanks, Angela. Antonio, you want to go?
Yeah, so very briefly, it's a very complex question, but very briefly to say, like Shuming and the panelists today have talked about crypto and digital assets are assets. So when it comes to recovery, it's not different, especially in cross-border nature of the recovery. It's not different than other assets that sit in other jurisdictions. What is a little more complicated within the digital asset space is the discoverability, right? The traceability and discoverability. And the one aspect of, specifically the question of conflicting jurisdictional regulations, what that we find when we're trying to trace and discover is in order to figure out where those assets are so that the right court orders can be processed, is the inconsistencies within the travel rule today in the crypto space. It's very nascent. But it's a great tool to be able to understand where the crypto or where the digital assets are being sent or received from, which really helps law enforcement and really help the legal community freeze those assets. And there is a lot of currently there's a lot of regulatory conflicting statutes. There's a lot of countries that don't have travel rule implemented yet. There's others that do it at $0, others at $3,000. The amount of information that has to be passed. There's no single tool for travel rules, so that provides a little more difficulty when it comes to tracing. But then tools like TRM and other tracing tools and the cooperation of the centralized exchanges and the centralized ASPs really help understand where those digital assets are and who own them and how to get to them.
Thanks, Antonio. Shumin, you want to just briefly address the ZipMax question?
I'm not aware. So for ZipMax, I'm not aware of any actual recovery or any actual recovery that's significant. I mean, we all know that it was eventually it was wound up. And just from experience, once you wind up, what's left for the customers is not a lot. And ZipMax, that case was special. Well, it was unique because there was a huge amount of customers, I think from memory, more than 60,000 that had 10,000 or less or 5,000 or less. So so the short answer is I'm not aware. I think to pivot a bit, the clearest case of recovery is in FTX that's currently ongoing. But even then, the recovery is touted as being quite favorable because the value of the cryptocurrency is valued as at the date of the start of the winding up proceedings, which is November 2022, and that was basically when prices were way at the bottom. As we all know, in the past few months, it's since skyrocketed. So it's being touted as, you know, everybody getting their money back. I hope that answers the question.
Thank you. So now let me just ask Monica to take your feedback. If you enjoyed it, we do have a lot more content. Join us again, Monica.
Thank you, Sharon. So if you enjoyed today's masterclass, we'd like to take some time to just quickly share with you the IBF programs, IBF credit programs that we have here at WMI. So our flagship program, which is the Advanced Diploma in Compliance Risk Management, is designed for experienced professionals to dive deeper into specialized and emerging topics. And for those who are entering the compliance space, we also have the Certified Compliance Officer, which is accredited to IBF Level 1. And then if you even want to dive deeper, we also have courses in specialized areas that will help to address current and future challenges in the compliance space. So yeah, to learn more, just scan the QR code on the corner. Lastly is our feedback form. So if you really enjoyed our masterclass, we'd really appreciate if you could just spend a couple of minutes to share your feedback. It really comes a long way in helping us to create and develop more future courses and masterclasses like this.
With this, we'd like to thank our entire panel. And I think the purpose of the feedback is if you enjoyed any of it, please feel free to reach out to any of the panelists and then tell us what other subjects that you'd like to hear about. Yeah, thank you all. Back to you, Florence and IBF.
Okay, thank you so much, speakers. That was for all your insights. I think before we go, may I just take a quick screenshot of everybody since we have everybody here. Monica, I'm gonna have to ask you to stop share for a little bit so I can get everybody into frame. Otherwise, you guys will be tiny and I can't see you. Okay, great. Everybody smile.
Thank you. We'll just bring up the feedback. Yeah. Looking forward to hearing from everybody and keeping in touch. Thank you all so much.
Thank you so much for having us.
Thank you.
Thank you,
Thank
everybody.
you.
Thank you.
To all those participants who had questions but didn't post them, you can still send them separately through, yeah? And if you do want the slides, just drop us a note. We will share that with you.
Okay, thank you, everyone. We hope to see you at the next masterclass. Thank you once again to our speaker.
Thank you.
Okay, goodbye, everyone.
Bye.